I want to talk about the notion of, let's call it wishful thinking in traders. Let's call it reminiscing about the past and wanting the past to repeat itself for our benefit. Last year I produced a video on the lithium boom that we had. And the boom in lithium stocks was the last true bull market that the ASX has experienced. And it is the last true movement in a group of stocks that by and large was really worth trading in any way, shape or form. And what has prompted me to make this video is that my inbox of late has been bombarded by people producing wonderfully clever little videos and statements about why you should be buying lithium stocks right now. To me, that is a narrative, that is a story, because from my way of thinking and my reading of the market, at present, I stand by this: lithium stocks are a bust. It does not mean that their time might not come again. And undoubtedly, with the electrification of our various bits and pieces of infrastructure, that time will come again, but it is not now. And this raises another point that intrigues me about traders. It is this desire to chase legacy trends. That is, to reminisce about what has happened in the past, to look back at a stock like Pilbara and go, well, if only I'd bought it at the initial breakout. They then project that gain forward and make the assumption that if they buy it now, they will get the same level of gain. That's simply not going to happen at present. Traders tend to look backwards at what was and wish it was happening now, and so they chase these legacy trends. Effectively, they go after trades that are not there. And one of the biggest problems traders have is trading what they feel or what they think should be there rather than what is actually there. When I produced the video last year, I generated this table and it looked at the percentage return from a 2-year period for a series of very, very well-performing lithium-based or lithium-associated stocks. And you can see they're exceptional gains. They're quite remarkable for anybody who managed to get on board these. But these are the returns of the past. They're not the returns of the now, and nor are they a projection of future returns. The marketing material I receive, and we'll call it marketing material, it's not really any form of well thought out investment advice. And it's a reflection of people's narratives. And it contains wonderful little charts like this, which looks at the sales of electric vehicles projected out to 2035. The issue is, this is not new news. We knew this in 2019/2020 when lithium stocks took off. Individuals don't discover something that the market does not know. Markets are not stupid. And you have to be aware of that. So it doesn't matter how carefully constructed the story is or how compelling it is. Unless the market agrees with you, it's just your internal narrative. And at present, the market's view of lithium, as indicated by this ETF, is that it's going nowhere. And that's true if you look at the performance of individual stocks. It's also true if you take a step back and you look at the price of lithium. We can see that the boom in stocks here in Australia coincided with the boom in the price of lithium. You would expect that. There is a close correlation between the two, and there is a correlation between the emotional investment people have in a stock and what they want, and these underlying macro features. To get a sense of what was happening at present, I fired up Market Index, which is a very interesting site and very, very useful for people who trade commodities. What they do is they break various commodities down into the representative stocks that they have here in Australia. But you need to be a little bit cautious. because the moment a commodity booms, every dodgy mining stock out of Western Australia suddenly changes its name and says it's involved in the search for that commodity. So you have to be a little bit circumspect about lists such as these. A lot of these stocks, particularly when you look at these lists, and just looking at this one here, many of the stocks have market capitalisations that are less than the price of an inner city home in Melbourne or Sydney. So they're very dodgy little things. But I broke this down into percentage returns for the past year. And you can see it's not a very pretty picture. Yes, there are some decent returns, but by and large, the majority of the sector has taken a hammering. And 68% of stocks in this list are in drawdown from a year ago. So knowing this, I thought I would return to this list and see what had happened in the intervening time between producing this and now. And this is what I came up with. All of the stocks in my initial list for the past year are in drawdown. So irrespective of what they did for the 2 years from 2020 to 2022, they're now, many of them, in significant drawdown. And so you have to be aware of that. And we can see this when we look at a stock like Novonix. We can see that there is a clear dichotomy between the initial breakout that occurred, let's be generous and call it June 2020, to the peak in December 21, and then the market falling away quite dramatically. This stock's been absolutely hammered. There's a slightly less dramatic version in Vulcan. Vulcan was very spectacular in the fact that it managed to throw itself from $1 to almost 16 in the space of a few weeks. But the same pattern emerges. We have this dichotomy between the boom and now the bust, with price now drifting down. So you have to understand that markets move in cycles. And unfortunately, what happens is people look at this chart and go, well, it was 16, but even better, it went from 1 to almost 16 in the blink of an eye. So if I buy it at 6, it will clearly go from 6 to, let's call it 140 in a few weeks as well. This demonstrates the lack of logic that traders have. It demonstrates their inability to look back at history, make a judgment that is separate from the narrative, to make a judgment from the fact that their neighbour bought a Tesla, therefore Teslas are everywhere, therefore I need to buy lithium stocks, and to actually look at the price action as it occurs. Because when we go back to our list of stocks that are done spectacularly well, we run into this situation where stocks like Novonix now have an 85% drawdown. And I can guarantee you, there will be people who bought this stock at its peak who are still holding it. There will be people who paid in excess of $12 for this, who are now holding it at $1.80, $1.81 or thereabouts, believing that it will come back. But that fails the test of understanding the gain you need to make on $1.81 to get you back over $12. So we come back to this problem. And the problem is highlighted by this notion of, here is our narrative. Here is my pretty projection of what the sales of electric vehicles will be to 2035. But that is at complete odds at present, and I say at present as a qualifier because markets change. They are never static. And the market disagrees. The market says, well, yes, we accept that, but we already knew that. So from the period of May 2020 to November 21, we priced that in. We understood that. We already know that. So there's nothing new that you're telling me. And more importantly, the underlying commodity is telling me a story. The underlying commodity is telling me at present that the price of lithium is drifting down. This raises the question, If the price of lithium is drifting down, then why on earth would you own lithium stocks? Yes, you can build any sort of narrative you want based upon future projections. But at present, the market already knows about your future projections, it knows about your stories, and it knows about the price of lithium. So we come back to the basic question. If all those things are held to be true, why would you chase a legacy trend and buy lithium stocks?